Stu, and then
All right, guys. Eric Mashinsky, Gold Investment Letter. We've got some special guests today from Amvest Capital, aka the Terraden Fund. How you guys doing?
good, Eric. Thanks for having us.
Yeah,
You
good,
bet.
Eric. Thanks for having us.
So I've known Gabe, I think the longest, and Stu actually, um, from back in the day. We met in New York and have stayed in touch and contact. And I really like what their firm is doing in the mining space. And then I was able to meet Tomas and Stu in Miami and learn a bit more about this Terraden fund, which I think is very unique for our investors as well, because it's specifically focused on critical minerals and rare earth and supply chain disruption issues with China. And so, this is something that I put some money in, was the last month. And basically, I wanted you guys to learn a little bit more from the guys that are running it. So maybe Gabe, you want to give a little background and who
Sure.
you are?
Yeah, sure. So Gabriel Mendoza. I go by Gabe for short, and I'm originally from Miami, and moved up to New York City in '08 after graduating, and just been in the mining sector from the financial services side ever since. I'm a co-founder of Amvest Capital, of the Terraden Fund, which we started Amvest Capital in 2017. And really, what Amvest Capital does is it sort of lives and breathes the mining sector, and really natural resources more broadly, but from the perspective of trying to find great investment opportunities and connect capital to those opportunities, and sort of unearth some really great stories. And Stu and I embarked on sort of building out the business, which included an asset management division. And we decided in sort of late 2020 to sort of give that a big push. And maybe I'll turn that over to Stu now, because we ended up connecting with Thomas again, and so here we are.
Yeah, thanks, Gabe and Eric. So I'm Stuart McQuiver. I'm from Perth, Australia originally, been over in New York for 11 years. I've been working with Gabe that whole time. My background, I'm a chartered accountant, or CPA as it's called in the US, and I have a postgrad geology degree from the West Australian School of Mines. And prior to moving to New York, I was in corporate finance in Australia. And then Gabe and I worked together, as he mentioned, set up Amvest in 2017. And I actually met Thomas in Western Australia on a lithium mine site tour. The mine's called Mount Catlin, and in this town called Ravensthorpe. And I was like, hey, I recognize your name tag. You're in New York, right? And so we stayed in touch. That was probably 8 years ago, perhaps. And then, yes, all three of us are based in the New York City area. And then we started forming this particular fund together in 2022, and it launched in 2023. And I'll pass it over to Thomas.
Sure, thanks, Stuart. Thomas Nadrowski here, originally from Switzerland, but my mining pedigree goes back to South Africa. I worked for AngloGold Ashanti for many years as a VP of business development, learning how to value different projects around the world as we were trying to replace the original South African reserves by doing deals with a lot of different smaller companies. I was also director of World Economic Forum and started focusing on critical minerals probably around 2016, 2017 for the first time, when I was running a mining book for a family office up in Connecticut. And that sort of pinned down my interest. We're talking here about smaller minerals, often metals that do not have very liquid markets. And it's a very exciting space with a technological change, both for the military and civilian applications. And then, of course, when we met with Stuart, we stayed in touch and decided somewhere halfway through COVID to launch a fund that's specifically focusing in this area, but in a way to avoid the Chinese value chain. So everything that's not related to Chinese equity, Chinese market, Chinese security, credit, partnership, you name it. So that's the essence of the story.
Great. So Before we get into some details on the fund, I mean, my group is pretty familiar with the rare metals, and I go back to the 2011 bubble that we saw in rare earth stocks, and ever since then, it's been pretty brutal, especially for the smaller companies. And so I'd love some comments from each of you on why now, because we're finally seeing a lot of this stuff in the headlines. I do some work with a group in Washington, and this is a big priority for them because the United States is in a vulnerable position with some of these critical minerals. There's several in particular, and probably at least 8 or 9 of them that would cause real issues if China continues to cut off the US. So why do you think it's time for these companies and stocks to start to outperform? Um, and does the environment that we're heading into, where this is more of a public knowledge scenario, does that drive this? Gabe?
So thanks for the question. I think there's a couple things to take into consideration in terms of stocks and performance of stocks related to these critical minerals, of which there's various. There's many of them. So we were a little bit early to the party in terms of Amvest as a whole coming in. I wanted to push rare earths. We wanted to push rare earths as an investment theme in 2017 after seeing the run up in lithium, because we said, well, lithium's a battery, the rare earths are the motor, and specifically talking about neodymium and praseodymium as being sort of the drive function of these cars, which is getting a lot of sort of investment dollars in the public equity markets. That didn't come to fruition right away. We saw it later on, and it was really related to something very different, which was more sort of geopolitical or supply constrained or potential of supply constraint. And so the stocks react to to more of the trends of what's happening than they do to sort of a fundamental long-term theme. Those usually take a long time to play out. Anybody who's an investor would know that stocks usually tend to sort of be different than what the fundamental underlying factors are. But if you talk to people about that are in the know on the supply chain of the demand side of the equation, that demand side is strong. There's some supply constraints in certain parts of the critical minerals space, which Thomas and Stu can talk more about. But the demand side is still very much there, and so what we're doing is we're picking spots where we think there's other things that we take into consideration, but we're picking spots where we think that there is supply mismatch as well, as a demand underpin.
So maybe let me just take it from there, Gabe. Eric, it's a good question, but let's define first what this space is. We tend to understand our portfolio as kind of falling into 3 segments, of which rare earths is just one. It's an important segment, and although neodymium and praseodymium, of course, attract a lot of attention, I think heavy rare earths are the real game. Terbium, dysprosium, as well as gadolinium, lutetium, europium, yttrium, for a number of reasons related to mostly technological stranglehold that China has on them, and they proved recently that they're willing to use it in a broader trade war. That's only one of the 3 segments. The other segment that we pay a lot of attention to is specialty minerals, which are not rare earths, but are rare metals. They are also controlled by China largely, and that's gallium, that's germanium, that's antimony, that's tungsten, that's high purity alumina, that's fluorspar, and several others. And so it's important to keep in mind how these things trade. And in a way, you have to look at it from the market perspective and the geopolitics and the sort of a tug of war that's occurring there, because the 2 worlds don't really speak the same language. I see the difference between when I'm in New York and in DC. And the third segment are battery materials. As we started with battery materials, the lithiums, of course, vanadiums, niobium potentially for anodes, graphite, and so on. So you see, for example, that this week, when we have a little bit of a, I wouldn't call it a truce, maybe a ceasefire in the trade war, all the strategic metals that I mentioned, the specialty metals and rare earths, have been basically sold off on a pretty vain hope that a solution will be found to this big geopolitical struggle where you have two incompatible economic systems, while the lithium names that have been under pressure for a lot of time have somewhat recovered partly. So there's a way to trade this thing in terms of which way the wind is blowing, if you sort of incorporate those three different segments into a portfolio. So depending whether we have a little bit of a detente in the geopolitical sphere, or whether China is turning the screws again. And just to remind everyone, when China slapped the most recent restrictions on exports of 7 different rare earths, it did it globally, not just against the United States. And then it threatened Koreans not to export to US products that include heavier earths from China. I was just in Japan and spoke with someone in Toyota, not a very senior person. They all know the names of the 7 elements, the 7 rare earth elements that China restricted. So it's a global problem. It's not just a US problem. It's a problem for US and its allies and partners around the world. So the opportunity in terms of investment, we actually have a fairly simple job because we have to identify the lower hanging fruits, given where the interest rates are. So things that have not too long a duration. But I think the government and the industry have a much bigger problem of rebuilding the value chain, because rebuilding the value chain from scratch is not just about mining, it's also about midstream, it's also about separation. This is complicated. A lot of money is going into magnets, recycling, for example. It's going to be difficult without primary product going into this for hybrid recycling forms. So it is a space in which we are trying to position ourselves for fairly straightforward pathways towards cash within a time frame that would be beneficial to the US from a strategic perspective, from the perspective of national security. And it's a fairly short time frame, I'm afraid to say.
Right. And Stu, we'll go to you in a second, but I mean, so your 3 buckets there, the rare earth minerals being one, it sounds like in the other 2, you have a number of what would be called critical minerals, right? You could go over to, I don't know if graphite is, but you put that in the 3rd bucket. And then we have, so it's not necessarily something that's classified as a critical mineral, but you do have critical minerals in both of those 2 camps, right? That you will isolate.
Yeah, so you know, the 3rd bucket, so specialty materials, they're not among the 17 elements that we count as rare earth elements. However, they are also controlled largely by China and absolutely of critical importance to technologies. Gallium, for example, for semiconductors, germanium for space, fluorspar, fluorite, if you wish, for both for nuclear cycle and for graphite production, HBA for sapphire, synthetic sapphire production, antimony, of course, for refractory and flame retardants and ammunition, tungsten for alloys and for also for sophisticated ammo, titanium for aerospace and so on. All of these are absolutely critical for both national security and economic security, and much of these value chains are controlled by China, and sometimes China and Russia at the same time, as the case of, say, titanium, vanadium, some others. And you have sanctioned material from Russia that leaks through the Chinese market and floods the market. So we have to be cognizant of the fact that Gabe alluded to, is that China's strategy is to make sure that this is not easily investable in the West. So we have that in some of these materials, on the one hand, they control the spigots, control which company in the West is allowed to receive certain products. On the other hand, they do it by dumping it at much lower prices, so that there's no incentive in the West to invest. And of course, our capital costs are not comparable to a deflationary China's capital costs. So this is a broader issue because there's a strategic intent on the Chinese side to prevent these value chains from being rebuilt in the West. But they will be. It just takes a little longer. And we're concerned that we have to be focused on those projects that are really the first to come out of the gate. For example, in Antimony, we invested in the first project that will bring new production. Doesn't solve the entire value chain, but it solves at least the mining side of the value chain. We do, however, look at some of the midstream plays. So the stage beyond the mine gate, where the kind of first most important chemical compound is built for, say, tellurium or gallium or germanium, beryllium, and so on. So that's an important piece, and that's a piece that's still unresolved for rare earths in the West.
Cool. Stu, you want to give some comments?
Yeah, I think on some of these metals that have been underlooked maybe 10, 20 years ago, but have strategic importance to a modern way of life, they're coming off smaller tonnage bases. So say gold, silver, iron ore, copper, they're big markets, well-established markets, typically traded on like the LME, which actually is owned by China, or Chicago Mercantile Exchange. And some of these minerals aren't traded on an exchange, so commodity traders can't easily buy and sell them. So the next best proxy is the equities on them, which is where we come in. And as some of these minerals that 10, 20 years ago had an industrial application only, but now have an electronic application, and doesn't have to do anything with EVs. It can be your mobile phone, can be AI, data centers, semiconductors. They're all used in that. So as the demand from these metals should be going up, significantly in our view, but from a very low base, it is harder to switch on supply versus, say, iron ore. You could do an expansion at a brownfield asset, and it might take a year or two, but it would be easier to turn that on versus, a brand new antimony mine in the US or Australia or Canada or etc. That could take 10 years. And so for us, we live and breathe the sector and the way it's evolved, kind of, in the Industrial Revolution, when coal was the first metal to become a source of energy. A lot of these companies created joint stock companies, corporations, and they were financed out of London. And then as, England, ventured into countries like Australia and Canada, realized there's, prolific mining regions and the geology was incredible. And South Africa as well started mining industries 200 years ago in those three countries. And then the local Canadian, South African and Australian capital markets became used to financing mining exploration companies. And so for generalist US investors, a lot of these companies and these equities aren't listed in the US. So to access them, you've really got to think globally and trade ASX, TSX, London, Japan, European equities. And that's our bread and butter and our full-time focus.
Great. So maybe we'll go through Gabe. You want to just talk a little bit about the fund itself, the structure, minimums, things like that. And before that, though, do you have any particular mineral that has your attention the most in terms of how screwed the US is?
Thomas is probably the best place to answer that, or I know he's got real passion for that question. So,
okay.
Well, absolutely. Dysprosium is that metal, one of the two heavy rare earths, with gallium probably coming a close second. So we currently don't produce either, although it is possible to rebuild these things. On the gallium side, it's probably easier because it could be extracted from alumina refining by just incentivizing producers to build that part of the flow sheet. On the dysprosium side, we just have to fix perennial problem of ionic clays, rare earth deposits, which have sort of a larger component of heavier earths, but filtering is a problem in these processes, especially the traditional filtering. You're going to use a lot of the fines where most of the value of these heavier earths are. And so this is sort of in process right now. There's several juniors operating in this space in Brazil and in Africa as well. And it's a sort of slow moving process. There is technology to deal with that, but it's controlled by the Chinese, and it's illegal for Chinese people to export this technology to the West. So I think right now the West is still over dependent on basically one Australian company that has a bit of a handle how to treat non-ionic clays, and then one old French company with octogenarian engineers who actually helped develop this business in the West before it all migrated to Japan. Sorry, to China. So probably these two metals are those where I'm mostly losing my sleep. The distant third would be antimony. But here the response from at least the mining side has been a little less fraught, and that's because a lot of gold deposits are associated with antimony. It used to be a refractory problem for a gold mine, and now suddenly we realize it's a very interesting byproduct, or even the main product, except you cannot actually report on ASX as a co-product with gold. You still have to report as a gold equivalent number.
Yeah, it's
So
interesting.
that's going to be solved too.
I was when I was in Perth last September, October, I was meeting with some of the management teams from some of these Australian companies, and one company we're invested in is restarting an antimony, tomato mine in Eastern Australia, New South Wales. And it's fascinating to hear that the US ambassador to Australia and the Aussie ambassador to the US are speaking every 2 weeks about this particular mine. When is it coming online? Can the US get access to the antimony to replenish the stockpile? So it's good to see that, you know, what was once forgotten minerals and afterthought is really front and center in a lot of people's minds.
Yeah, so for us, as I said, it's an easy job. We just have to identify the undervalued stories. For the government, it's much tougher, because what do you do with this antimony next? The only smelter that existed in Oman is offline right now. So it should be a policy to incentivize US capital to rebuild these value chains globally. We're not going to build everything in the United States. It's not going to happen. We don't have the skill set, and you actually need a real volume to make it profitable. So there is, in some of these metals, the problem really is at the midstream level, more so than in the mining level. But we as a fund, we're not going to be able to solve that. That requires much bigger guns to push that through. Right now, I don't know where that product will go when it comes out from New South Wales, but it's a problem for 18 months from now. So maybe there will be some solution.
Well, there's also just maybe comments on we all know about Perpetua Resources in Idaho. So they had, they have a 5 million ounce gold asset that basically, because of I'm going to call it antimony byproduct, received up to, I think it's 1.8 billion in government help from various agencies in debt and or grants. But I've looked into it, and even with the stage that Perpetua is in, which is latter stages to a mine decision and building that, we're probably not going to see any of that product come out of the ground for what, 3 years, 2.5. And it's unclear to me what kind of runway the US actually has, like with stockpiles of things like antimony. It could be even less than that. So what are we going to do then? There's going to be bandaging, with places like, I made a suggestion to some of the special ops guys to get diplomacy going with Bolivia, who ironically has 14% of the stockpile of above ground antimony approximately. So they're going to have to get creative. But even with what is being built here, there's really not that much of a supply boost coming in the near term. I think that's the problem with a lot of people. They don't understand these things take 15 plus years to get going.
That's very true. At the very beginning, you mentioned the first bubble in 2011, and that bubble happened because of the conflict between China and Japan over rare earths at that time. And unlike, our successive governments, Japan actually did the homework, and they figured out how to stockpile properly, how to recycle properly, how to build a proper pipeline, how to support the right companies in Australia when they had to, or Vietnam for that matter. And so in a way, they solved the problem for themselves, and we were just sitting on our hands doing absolutely nothing. So you're right, we're far away from solving that. So, Bolivia, I don't know. Luis Arce, the president, seems to be as far left away from our part of the world as possible. So I don't know what it takes to change that government, but right now it's not extremely friendly. I mean,
That's true.
that particular, because it's known for its lithium resources, not particularly helpful because a lot of magnesium, difficult to process this. But right now it has Chinese and Russian companies all over it. So that's what Bolivia has become.
Well, I know the banker that put San Cristobal back into production, so
Back in the
we'll
day, yeah.
we'll have to give it a shot with them. Probably gonna have to try everything. But Gabe, any comments on the fund itself? What you guys are, where you're at with AUM, how many companies you hold, performance, things of that nature, and just the value proposition in general.
Yeah, sure. So the fund is set up as a traditional master feeder structure, which means that there's a main master fund which feeds two, in this case, two sub funds, and it's set up that way to allow for offshore investors who are not tax reporting in the U.S. to participate, and also allows, obviously, we're sitting here in the U.S. for a domestic U.S. Feeder into that master fund. So in terms of the offshore fund, there's a minimum investment of 100,000. In terms of the onshore fund, there's a minimum of 50,000. And right now, in terms of AUM, we are sub 10 million of AUM. I'll just mention that the strategy that we have can scale to over $1 billion of AUM and still maintain, the sort of diversification that we have from a portfolio concentration standpoint. And I'll let sort of Stu and Thomas talk about the positions, but we currently have over 20 positions. And I think we've got performance numbers up until the end of April, ready for distributions. Is that right, Stu?
Yeah, that should be any day, but performance since inception, up about, including April, about 40%, and the benchmark's down around between 35 and 37%. The benchmark for us is the New York VanEck listed ETF called REMX, the Rare Earth Strategic Mineral ETF.
But I would highlight that, just to say that one more time, Stu. So and also you can use several other benchmarks. I think we did this, Thomas and I did this the other day, where we took every ETF that one could buy if they wanted to allocate to this space, and all of them are pretty much down the same, except for one income vehicle that's really has like everything from like BHP and Rio Tinto, which doesn't really count in our opinion. I mean, and that one's still down. So the alpha, let's talk about the alpha, right? Which is why you're paying us fees to manage the money. Okay. So what is the alpha? So the alpha is
70%.
70% over 18 months.
I think it's good to also mention that this space is fairly decorrelated from the mainstream market. If you just think about April, which is fresh in our memory, so Liberation Day and beyond, the mainstream market really suffered badly, and I think most portfolio did. In April, we earned 17% positive, right? So if your view is that the tensions with China will continue in some form or fashion, that's a good addition to a broader portfolio. If you have exposure to, I don't know, NVIDIA, Apple, or whatever else needs peace, this space will benefit from the opposite and at least offset some of the volatility of a broader exposure that many people have in their portfolios.
Stu, any additional comments? I mean, you
in
guys
terms of
have like a fee structure that's actually very friendly to investors.
Yeah, fee structure is 1% management fee and then a 15% incentive fee over the lower of the hurdle rate, sorry, which is the lower of 5% or the benchmark performance. So the VanEck ETF called the REMX. And then in terms of company composition, we have a combination of investments of companies that are in production, in development, in exploration, and then stock exchange split is ASX, New York, NASDAQ, TSX, 2 Japanese equities, and Amsterdam Euronext equity. We used to have a London position, so we're quite global and in that nature, but you have to be in this space given might be called 12,000 investable names in the mining universe, and most of them are not listed in the US.
Also very important to mention, I talk about that sort of scale that the fund can have. And it's not because we're investing in a bunch of $10 million junior miners. That's not how we got the performance that we have either. That's a very important. So we're buying big things and some small things. But what today, Stu, could you what's the average market cap of the portfolio?
I must be best to answer that, but
It's
probably 500 to 750.
Around 400. Yeah.
Yeah. So we're not buying $10 million, $20 million juniors that move up 50% and then move to 5 million in market cap or whatever. I mean, these are real moves with real liquidity.
Well, that makes me sad. I like the $10 million ones that go up 50%.
We might dabble in the occasional.
And you do, right? I mean, I know the example of like Ares Mining with the fluorspar mine. I mean, they're not a very large cap deal, but that's a very interesting story. So I'm sure you're selective with how far down the rung you go, but some of those stories are just valued improperly.
Yeah, agree. Definitely, you can have some great opportunities there. The RS one we mentioned, my personal favorite, but you have to make sure you're very close. You need to make sure you can get updates from the company regularly. And it's hard if you're doing this part-time to just dabble in the space. For us, we live and breathe this space. We can access management weekly, monthly. We would know other people involved in the company from management, directors, or other shareholders or brokers involved. So, and that's quite global too. And we have access to the private placement offerings in Canada, not just Canada, but Australia, London, and the US names as well.
Also, the other reason why it's better to leave this in the hands of professional, in addition to mining knowledge, which all of us have, you have a pretty good handle on how the technology changes and how the threat of the substitution of certain materials is pursued by certain producers. And also the space is very volatile. So say 95 VAR is at around 15 or something like this. 99 is going to be over 20. It's not for everybody, unless you have a very, very healthy heart. So, it's better to leave it to us to manage this because you actually have to trade around it actively.
Yeah, the last question I have for you guys, and then we'll wrap it up and give everybody the information on who wants to be the point once we send this out. If we have some people that are interested, but on your fund summary that I have, it was Q1 2025, but it was the first bullet point there about global equities of mining, and then the last part of that bullet was other carbon reducing technologies. Question I have for you guys is, what about this whole carbon reducing story? We've seen decimation and a complete 180 of the importance of this, seemingly, with the Trump administration. So what are your thoughts on, I mean, this trend is bigger than any administration, I think, but you know, the bloom has come off the rose a little bit in terms of this being a priority. So how do you see, you know, still sticking within that theme of battery storage and things of this nature, um, the growth, if we're not politically going to be motivated to do these things?
It's
Right.
an interesting question, Eric, because I think there is a confusion between the technology and the specific application and the political color of this application and that application. Battery technology is going to stay with us, or indeed accelerate in different directions that we don't know yet, in which exactly cathode will win, 2 or 3 years from now. But it's a technology that's going to be with us for a variety of reasons. I mean, think about the drones in Ukraine, right? How this war has been changed over the last year, suffused with drones. Well, you need batteries for those drones, and not too heavy ones. It's a problem with graphite.
And
Not just
magnets.
yeah, not just so, just to stick to the battery issue, it's not about just transportation. We know that why China developed this. China developed this to domesticate sources of energy. That's why they needed to just move away as much as possible from maritime trade in liquid fossil fuels, especially from the Persian Gulf through Malacca Strait. So it helps them to solve the Malacca dilemma. This is a different reason from the reason that was presumed that this is just decarbonization story. You cannot have decarbonization story on the back of Chinese technology, as simple as that. However, the battery technology as such, it's going to advance. It's going to probably help not only just with transportation or even, space technology and other technologies and military applications. It's going to be also helpful maybe for some new form of maritime transportation for those who do not have access to nuclear. So it's important to factor it in. You just have to watch technological changes as they move from invention to innovation and commercialization. Not all of them can be commercialized, and unfortunately, a lot of them get pilfered as well and plagiarized. But we're in it to invest in minerals. And if we see a significant gap in terms of mineral supply and demand, you mentioned fluorsporic, niobium is another example, just with along changing technologies, there is an opportunity because the mining space takes so much longer to respond to that technological pool. It's easy to change things in the lab. It's a little tougher to build the entire industrial base, but it's much tougher and much longer to dig it out of the ground and actually bring it to the market. And we're looking for exactly these tensions.
And one thing
Great.
just follow on to that. There's two themes that Thomas touched on that I'd like to sort of expand on just briefly, which is one is the one at the end, which is the time theme. So, administrations here are 4 years, but the time that these things actually take to develop and in terms of the technologies and then the adoption time is significantly longer. I mean, in decades, in centuries, right? In terms of, how we're adjusting our use cases and how we're adjusting our lifestyles as a society. So that's the first thing. And then the technology piece that you mentioned, well, you got to keep Jevons paradox in mind, because basically what that means is the more that we are adopting a new technology, in fact, the more material we're going to need to support it. And so it's not a situation where as things become, more developed and in fact more efficient, it's going to become a use case where you use less and less. In fact, you're going to use more and more because it just becomes that much more prevalent and more accessible. And so, and that just by the law of numbers makes it an exponential need. So I think those two things you need to keep in mind as an investor in the sector, where you really are playing the long game, but you have to be active in how you do it, and you got to keep your ear to the ground and make sure that you're playing, like, if you're a quarter to quarter or a year to year performance, you really have to look at it from an active point of view. And then at the same time, you want to make sure that you keep a base of sort of that long-term view in the portfolio to benefit from that move over time.
Stu, any closing comments?
That's a space that's getting a lot more attention, which is a good thing. When I moved here to New York 11 years ago, you might see one gold company, Barrick and Newmont, on CNBC or Bloomberg once a month, coming from Australia where it was in the press every day. But now, you're seeing, Wall Street Journal to NPR to New York Times, all the news applications, and CNBC and Bloomberg discussing, the importance of mining, where things come from. And, it's good to see that people are becoming more aware of it. And, what the sector needs the most is been starved from equity capital for several years. The Chinese figured that out about 20 years ago. And so now it's time for, us in the West to increase equity exposure to these types of companies and support the development.
Great. And so we'll wrap it up so people watch this and it doesn't go too long. I think we hit on a lot of the key points. So who should anybody contact? Who wants to be the point person? What's your email address? And
we have an email that goes to all of us. So it's terraden@amvestcapital.com, and that way we can make sure any inquiries are routed to the right person.
Okay. That sounds good. Yeah, I mean, it's actually, I think, a very exciting time for this. We didn't really get into too many of the particular metals, but things like vanadium and things that people just have never heard of. These are all like new dysprosium. Like, there's a very small segment of the world that knows about it, but it's so critical. So, I think that Gabe's comment about the expansion of this as it becomes more accessible. Look, I even tell people you can go to an AI conference, and what's the limitation? It's compute, energy.
Mhm.
Where are you going to get the energy? You better have nuclear, you better have battery, they're going to need everything because that's the limitation on speed. So it's all connected, in my view, from above ground with what we use in our day to day, and below ground where we have to get it out and then process it, or that's going to really restrain the speed of development of a lot of these technologies. So that's why I put some money in. You guys are capable of the global exchanges and vetting these deals better than anybody that I've seen in terms of really specializing in this area. So I commend you for that. And I'll give the email Terraden@amvestcapital to all the folks that watch the video.
Thanks, Eric, and thanks for your support in the fund and obviously over the years. And thanks to all the viewers as well. We look forward to answering any questions you have.
Yeah, again, thanks, Eric, and definitely appreciate your support. And yeah, as Gabe mentioned, we're here to answer any questions.
Good deal. Thomas, anything from you?
Well, I think it's a real opportunity, as Eric mentioned, that's emerging now. But I think it's good to think about it in longer term. This is not something that's going to be turned around really overnight. I think it's good to build exposure to these things over several quarters and not to be too concerned by the short-term gyrations. That's probably the best attitude to this, because it's volatile and because of those two levers that we have, the market lever and the geopolitical lever, that create a lot of those zigzags on the chart. But we're here to answer any questions. Could be questions that are specific to specific metals, specific exposure. We have quite a big depth and also the network around the world that could help people understand, what's at and which direction this is going. So feel free to reach out to Terraden.
Great. And maybe after we get an initial feel for this, we could do a follow-up in maybe like a month where it's digging into the details on a few of these minerals and just walking through that supply chain and giving people a real hands-on understanding of the issues. So I appreciate it, guys. That'll be it for today. Thanks for joining us.
Thank you
So much.
Thanks.
Thanks.